The nation's absolute wealthiest elite are quietly pulling off a massive financial heist right before your eyes. And the worst part is that you're the one funding it while your own hard-earned wealth leaks out to the tax office? If you've accumulated over $300,000 inside Australia's institutional walls, you're their prime target, this EUFI. Today, we're breaking open the vault to reveal how the top 1% legally shelter $250,000 in clean profits using targeted moves inside top-tier industry funds. It's an aggressive roadmap that's completely hidden from ordinary working Australians. You'll see how to leverage advanced allocation frameworks to instantly stop the bleeding and completely shift your compounding trajectory before the 30th of June cutoff point. But let's establish a hard boundary right here. Remember, this is educational information only, does not constitute personal financial, taxation, or legal advice. Always consult a registered professional before shifting your capital balance. Now, let's uncover why the corporate system relies heavily on your total compliance to fund their operations. If you're passive, you're losing the game. The elite don't leave their money sitting in generic, low-growth cash spaces. They use the legal architecture of the ATO to completely wipe out their highest personal tax exposures. It's a precise mathematical strategy that transforms ordinary retirement balances into genuine financial fortresses. Let's dismantle the system step by step. To play at the elite level, you must first understand the true power of maximizing your advanced concessional contributions framework. For the 2025-26 financial year, the standard threshold has been indexed to an official limit of $30,000. This represents an immediate, high-powered opportunity for anyone sitting in the upper marginal tax brackets of 37 or 45%. If you're earning a strong executive salary, every single dollar you claim above $45,000 or $135,000 is heavily exposed to state collection. But when you coordinate an aggressive salary sacrifice arrangement directly with your corporate payroll team, you're legally instructing them to intercept that capital before individual pay-as-you-go withholding can ever touch it. That intercepted cash bypasses your personal income ledger entirely and lands directly into your industry funds or retail funds taxed at a flat rate of just 15%. Think about the structural math behind that single transition. You're instantly reclaiming up to 30 cents on every single dollar and placing that rescued profit back into your own personal compound engine. It's an absolute financial no-brainer that most professionals completely forget to adjust as their earnings scale over time. They let their baseline employer guarantee tick along passively while they absorb massive unnecessary tax bills at the end of the financial cycle. But the elite take this concept significantly further by exploiting historical carry-forward provisions. If your total balance was under $500,000 on the 30th of June of the previous fiscal year, you have the legal right to claw back every single dollar of unused cap space from the preceding 5 years. This is how a high-net-worth individual can instantly inject a massive lump sum into their portfolio and claim enormous deduction that slashes their current year taxable obligations to absolute fractions. It's a massive wealth accelerator that the system rarely advertises openly because it strips immediate revenue from the government's cash flow targets. If you leave your funds sitting unoptimized inside generic investment profiles, you're basically handing the system a free financial pass. You must look at your historical statements through your MyGov portal and calculate exactly how much unutilized space you have left before the clock runs out on this financial year. Stop right there. Let's enforce an absolute dramatic pause, because this is where most high earners lose complete control of their wealth journey. I need you to drop a comment below right now and tell me your single biggest financial headache or tax frustration this year. Expose what's keeping you awake at night. Now that you've dropped your insights, let's unpack the exact tax deployment to make this loophole work for you. The core mechanism to accelerate this strategy is establishing a highly optimized salary sacrifice arrangement with your corporate payroll department. This isn't a standard payroll deduction. It's a legally binding pre-tax restructuring of your total compensation package. You're instructing your employer to divert a massive chunk of your gross earnings directly into your chosen fund before individual pay-as-you-go withholding is calculated. But you must move fast, because payroll systems require processing time before EY. If you delay the paperwork, you'll miss the window entirely. Now, let's address the massive financial trap that explicitly targets Australia's highest earners. It's an institutional penalty known as the Division 293 tax threshold. If your combined personal income and concessional contributions blast past the $250,000 milestone, the ATO will automatically enforce an additional 15% tax on your superannuation inflows. It's a highly targeted clawback mechanism designed specifically to penalize high net worth individuals who fail to map out their cash flows before the 30th of June deadline hits. Most corporate executives receive their Division 293 assessment letters months after the year ends, causing absolute chaos in their liquid cash reserves because they didn't factor the liability into their overarching wealth strategy. Managing this requires an institutional understanding of how your total remuneration package is structured between base salary, bonuses, and compulsory superannuation guarantees. If you don't track your position proactively, you'll slide straight over the threshold line and face an unexpected debt notice that strips away your hard-earned financial momentum. But even if you optimize your contribution strategy perfectly, there's a lethal hazard waiting for you in the final weeks of June that can completely annihilate your entire tax deduction plan. It's a widespread institutional disaster that we explicitly call the BPA death trap. And it absolutely destroys thousands of retirement plans every single financial year. How does the BPA death trap actually catch successful professionals off guard? It's deceptively simple. An investor waits until 28th June or 293 June to transfer a massive $50,000 lump sum into their industry funds or retail funds via their personal online banking interface. They assume that because the funds leave their personal account instantly, their tax deduction is safely secured for that financial year. But that's an incredibly dangerous mistake that will cost you everything. According to strict ATO legislation, a contribution is only legally valid when it's officially received and cleared by your superannuation fund provider, not when you initiate the clearing request from your retail bank. If the interbank network takes 2 or 3 business days to process that heavy seasonal transaction volume, your capital won't land until 2nd of July. Boom! Your entire catch-up strategy is legally disqualified for that fiscal year. Your available cap space for the new period is accidentally choked, and you're suddenly hit with a massive, unavoidable tax bill on money you thought was completely protected. It's an absolute administrative tragedy caused by simple transaction lag during the busiest financial week of the year. To bypass the BPI death trap, you must initiate your transfers weeks in advance or coordinate directly with your fund managers to verify real-time processing cutoffs. The ultimate insight to achieve true financial sovereignty is realizing that you cannot rely on default institutional frameworks to safeguard your capital. The multi-millionaire class treats their positions inside top industry funds as active corporate entities requiring constant tactical adjustment. When you optimize your investment options away from low-performing, default balanced options and align them with high-growth sectors, under a heavily minimized tax environment, you create an unstoppable compounding engine, shifting $250,000 $1,000 into clean, sheltered profits isn't a fantasy. It's a predictable result of aggressive asset positioning and bulletproof timing before the UFY clock expires. Remember, this is general information only, does not constitute personal financial, taxation, or legal advice. You must execute these structural changes with absolute precision to permanently lock down your hard-earned wealth. Don't let institutional inertia or administrative traps steal your financial independence this year. Take absolute command of your accounts right now and review your contribution history before the 30th of June gates close forever. If this deep dive opened your eyes to the hidden wealth leaks, prepare yourself for what's coming next. In our upcoming exclusive video, we're going to completely unmask the hidden fee structures that traditional retail funds use to quietly siphon off your wealth month after month without your explicit consent. Hit that subscribe button to Aussie's Super Secrets right now and stop giving the tax office another single unearned dollar of your money. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets, all rights reserved.